Dave Reeves, Managing Director, Calidus Resources. Calidus is a gold producer in the Pilbara of Western Australia, sitting at around 70,000 ounces per annum with a clear pathway to 130,000 ounces per annum.
Dave, good to see you.
Likewise, mate.
Well, welcome to me to Perth.
Lovely to have you in Perth.
It's good, it's good. Hey, look, we haven't spoken since September, okay? Yep. Tough market last year. Been very tough on you this year. Yes. I leave you alone for 5 minutes.
Oh, dear,
and the share price is halved. What the hell's been going on?
Yeah, look, it's been a roller coaster ride, I think it's fair to say. Yeah. Certainly I don't believe that the market has done justice to where we are today, and we've just put out that announcement about a January update. But, there's obviously shareholders have concerns. The feedback I get is everything from where our all-in sustaining cost was looking at, to where our balance sheet is, those sorts of things.
Let's do two things. Let's do two things, right? Operationally, released today says it ain't so bad, right? It's not so bad. I want to talk about that in a minute, but let's talk about the cause of the concern, which is, anything happened last year apart from inflation and sort of massive depression in the market? Plus, with the balance sheet, obviously, we need to talk about that as well. Yeah. So can you sort of address the kind of financial concerns first?
Yeah, so, when you talk about last year, we saw most of the gold producers here down 40 to 50% at certain times. We had labour issues, COVID, coming out of COVID, all those sorts of things. Yeah. So a lot of those are seen sort of washing through, but with our slower startup, we had some water issues, mining issues, other things. We weren't producing enough gold. So all of that sort of washed through to see where we talk about financials and balance sheet. We've been paying some debt off, but not enough. And I think that's one of the concerns, is that with all of those issues last year, it was a slower startup. We weren't making as much cash as we would have liked. And people are sort of nervous about where that's
right. So there's a few things going on there. I want to be really clear with people, because operationally, I think there's a kind of good news story, right?
Yeah.
But you got to tidy some stuff up. So yes, equities were out of kilter with gold price, but gold producers were should have been throwing off a ton of cash more broadly in the market, right? Take that as fact. You guys were in that kind of startup phase. So in fact, remind us the scale of the opportunity in front of us in terms of the size of the project, how many ounces you...
Yeah, so starting at around, guidance we're given around 70,000, building up to 130,000.
Right, that's the last conversation we had. And your goal was to reduce the obviously cost of doing so through the kind of ramp up phase. So what actually happened? Water was a part of it. What else?
So we just didn't have the throughput through the mill, and with that you don't get ounces. We also had some...
And why was the throughput not as much as you thought it was going to be?
Because we had a lack of water. The water was an issue because the water balance that was done as part of the feasibility, I could really bore you with the technical details.
No, I kind of want to know, because you've been hammered hard by the market. You've had people dumping stock in a big way, and that's caused a change in sentiment where perhaps there may not needed to have been. So I think it's important to get into it.
Yeah, look, and I think we can dwell on the past and what happened with the thickener, but what I think we should be looking at is that we've been talking about that for the past 4 months to the market.
Right.
And what we should be talking about is today's release, which says that we're actually operating at above nameplate. Those water issues are gone. So, to me, we shouldn't worry about so much
you may say that, but for me, I've not spoken to you since September. Yeah. I am concerned that your ability to kind of forecast and predict behaviour of your operation is solid. It's good, right? So I get you're operating at nameplate now, but you didn't foresee some issues there, or something happened that was force majeure or out of your control. So what was it?
So the thickener recovers water for the plant.
Right.
We've got two types of ore, if you like, transitional and fresh, and they behave differently in the thickener. The test work that was done as part of the feasibility basically didn't pick up that the transitional, you recovered a lot less water out of this device, and therefore there was a hole in the water balance. When you don't have enough water, you can't mill as much, your tonnes are down.
Right.
So to fix that, we've had to put more bores in. Okay. And it's also been fixing itself as we go deeper into the fresh. The thickener now performs as it should to recover the water. So there's been a combination of things there that we've put more water into the system. The thickener's now operating better anyway,
right?
And we're doing some further works on that. So the water is resolved, and that's what stopped the tonnage.
Okay, and here's why I think it's important to talk about stuff like that, because your current shareholders obviously appreciate that and they're watching closely.
Yeah.
And they're doing either sitting on their hands or they're getting rid of stock. There's a whole bunch of people sitting outside your story going, actually, this thing is properly heavily discounted. If I believe that these guys can continue to produce and go from 70 to 130, this is a real bargain. Sub 100 million market cap Aussie, right? So that's why I think I want to talk about
fair
that.
enough. No, it is. And so those issues are resolved. The mill, as we've said today, we're operating in February, we've averaged 347 tonnes an hour versus nameplate and transitional of 300 tonnes and nameplate of fresh of 260, and we've got mainly fresh. So we are far exceeding throughput now. And we've actually been stressing it above that to see how far we can push it.
Right.
But I think, what we've said in today's announcement is, March quarter, the remainder of the March quarter, we want to operate at 10% above nameplate. So that 10% obviously gives you 10% more ounces at the same grade.
Okay. Are you reducing costs?
So by producing more ounces, you reduce costs.
Right.
That's the bottom line. If you're still moving the same amount of material, yes, your operating costs go up a little bit, but no, your all-in sustaining costs, as you produce more, as the head grade comes up, your costs are pretty locked in on a monthly basis, so it's really fluctuated with ounces.
Okay, if you can maintain current run rate,
how
much money do you make at the end of the year? Assuming the gold stays roughly where it is.
Yeah, so obviously we've got certain sales at spot, certain at hedge, so you've got to factor all...
Blended as what?
Blended, call it 2,500 Aussie an ounce we receive for the remainder of the year. And we've given guidance in the first half, I think it was around 2,150, we were saying. So a little bit of margin there, 20 odd million you're making from the ops.
Right.
But as we move forward, as our strip ratio reduces, our mining rate reduces, our mining costs reduce, our all-in sustaining costs reduce, and we'd be certainly aiming for, well under 2,000 in that 1,800 to 1,900 all-in sustaining range.
Right. And because you said the more you put through, obviously the more your costs come down, but you named some of the other variables which you need to focus in on and help in terms of that reduction to get below 2,000, right? Because people are looking and going, it's a bit tight. It's a bit tight. What we don't need is going to relapse in gold price because they'll make your product marginal, right? So you don't want that. So again, is the solution, we will put more through, we will...
Yeah, so by increasing capacity, which we're doing, we're constantly improving on our grade with better mining techniques. It's been a bit of a learning curve on what we need to do there. And our reconciliation, as we said in today's one, is now down at 7% differential, which is excellent.
That's good.
So that's improving. So with all of those improvements, in particular, that's what gives you more ounces, reduces costs.
Right. So how do you move from 70 to 130 without blowing the balance sheet?
Yeah. So we obviously need to generate cash to both pay back debt and to do development of new operations.
Right. So remind me the debt obligations.
So end of last quarter was 102 million over the next 3 years.
Okay. What's that? Paid quarterly, was it? I can't quite remember.
Yeah. So you're looking at somewhere around 8 million principal per quarter on that. And obviously interest rates have gone up.
Yeah.
We're at a margin to interbank rates.
Yeah.
So that's gone up and the interest load has gone up with the current financing we've got. And that's why, we've talked about refinancing of our debt is very important because we need to try and, through various mechanisms, push some of that debt further out, reduce the interest burden and use that cash we generate to then do the development to expand to 130, because the more ounces we produce, the less influence the hedge had, the lower our overhead cost per tonne is. Everything it's self-fulfilling.
It's self-fulfilling. Right, exactly the phrase I'm going to use. So you started looking at ways of refinancing the balance sheet. I'm sure you can't tell me till you've done it, so I'm not going to push you on that one. But you've got people like Macquarie who've seen you hit. You haven't had to delay anything or push any of the payments out with them, have you?
We always... And it's always part of any facility that you always relook at and recut your repayment schedule based on how you're going. So that's a constant.
But they or any other debt provider, because they'll be looking at what you did with Macquarie, they'd be kind of broadly happy with the way that you've endeavoured to pay down that debt schedule.
Yes. So we've been paying our interest, paying down some of the debt. And certainly, I think if you look at our performance and how ounces have been increasing, costs coming down, cash generation going up,
right,
it's a lot easier to look at that now than it would have been, say, 3 months
ago.
ago.
But it's pretty tight there. So what you don't want to do is, what you want to do is obviously, stretch a debt facility out a little bit, and maybe it's a little bit more expensive negotiating at the moment. So you're going to want to introduce some other forms, potentially royalties, potentially, hopefully not equity. Your shareholders will be saying to you. So what's the time frame you've given yourself? Because it's a bit tight.
We would like to resolve that this quarter. I think the market needs clarity, as do the rest of us. And I think, shareholders need to remember I'm the second largest shareholder in the company, so I'm going to be fighting hard to, maximise NPV per share from however we look at the refinancing.
Right.
And there are multiple options out there. And as you say, look, I can't say a lot about them at the moment, but said in today's release, we've got, I'm heading up to site tomorrow.
Yeah.
We've got a bunch of them coming through, the final part of their DD. This has been going on for 2 to 3 months, these conversations. So, we'll hopefully by the end of February, we'll have an understanding of where we are, and during, before the end of this quarter, we'll be able to announce.
I think it's kind of interesting because you're clearly good operators. You've built a mine. Very few people get there or can do that properly. Mining's tough. There'll always be bumps along the road. So I'm not, I don't think we can mark you down for that. And it's in a pretty difficult environment. Okay, so I'll say that on your behalf. I don't normally stick up for you.
Very kind.
I will say that for you. I'm joking, by the way, people watching, especially the Americans. I'm joking here. I like this project. Okay, so that's on the kind of operational side. With regards to obviously tidying up the balance sheet, you talked about some of the things that you want to be able to do with your cash. Once you've tied up your balance sheet, you're going to be able to do expansion work, obviously on the main project, but you've also got this thing called Blue Spec in the background as well. So what's the kind of on the want to do list?
Yeah, so we've got an underground at Klondike to put in, which produces more ounces, drops costs. But we've also got the Blue Spec project to develop, and that's getting really exciting. I've had some pretty good exploration success there late last year.
Yeah.
Drill rigs will be starting up again.
That's paid down now, isn't it? That's fully paid off, right?
So Blue Spec's fully owned.
Yeah, brilliant.
And that's a 10 gram through the mill ore body.
Yeah.
So obviously super high grade, helps bring ounces on. But I think the most exciting part to me is this exploration we've been doing nearby, 6 kilometres along strike from Blue Spec. We've discovered the Felix, what we call the Felix deposit, and there's 2 parts to that. There's a lower grade area off the main Blue Spec fault with some really decent intercepts in that we are following up with drilling. But there's another area where we drilled with 1 hole that is very similar to Blue Spec. So we had a metre at 220 grams, I think it was, a tonne in an interval at 6 metres at 40 from near surface.
Okay.
Which is very, and when we panned it, we saw stibnite. So it looks very similar to Blue Spec. That's what you get there, the antimony, the stibnite. So we're out there doing sort of grade control pattern on that to understand that high grade portion. If we've got that starting at surface instead of 240 metres below ground, which Blue Spec does because it's been mined before, that changes things.
It's really interesting because I think those sorts of headlines didn't mean anything last year, right?
Yeah.
But they kind of mean something to you. So you think there's some things that you did last year which you might start getting some sort of benefit once balance sheet is, or announcement of how you deal with the balance sheet is done. So in terms of allocation of capital, you clearly got the debt thing because you don't want to mess around there. But in terms of how much money you're going to allocate to some of this expansive work.
Yeah, so the sort of work starts slowly. When you start it always is you've got this S-curve where, in the middle of a project, it's peak spend. So, our costs and the cash generation we're seeing next calendar year are very good from Klondike on where we see the operation. They're a bit leaner for the next 12 months because of our strip ratio. But as I said, as that strip ratio drops, the cash generation really improves. So by then we want the projects to be well and truly started. So as that cash is generated, we can bleed it into those projects because they take time. It's not like you're saying we're spending 20 million this month. That takes time to spend that capital to get these projects up and running, and that's when the bulk of the expenditure will happen. We'll start the projects this year, but the bulk of the expenditure will be next year when the cash is being thrown off.
Okay, so it's fundamentally still a strong project, but you've been marked down a lot. I mean, what's your message to shareholders maybe, because otherwise you get this kind of this overhang situation, right? Where you go, oh, if I get anywhere near what I paid for it, I'm dumping. You got to kind of like, burst through the line there. You got to say, look, we will not only we operate 10% above nameplate, but we will get to here's the path to 130.
Yeah.
Right. And by the way, look at all this 10-gram stuff. How do you deal with kind of big holders in the market in terms of share register? Yeah, there's a couple of kind of like peaky offloading.
Yeah, no,
right?
we've seen a couple of holders just dump in one lot. Just
without a conversation with you.
Yeah, generally not.
Right, not that they have to, but it would have been.
No, look, everyone's entitled to buy and sell.
Yeah.
So there's no problem with that. I don't think they've helped themselves achieve the best price versus, if you want to exit sensibly.
Yeah.
Don't dump. It takes a while back. But I think more importantly, instead of talking about those mechanisms, it's how do we regain a trust of the market, and that's through constantly improving performance, which we saw today. It's a step up again, and we're seeing that step up in throughput again. It's looking beyond the immediate short term and looking at where we can get to. These deposits are real out there. The production profile is real out there. But I think for people to believe that as well, or not believe that, it's re-gearing that balance sheet so that people can see we can fund that growth. I think that's probably one of our main overhangs. And as I say, by the end of March, the end of this quarter, we hope to be in a position to tell people how we are refinancing, how that frees up cash. In the meantime, yes, we've still continued to improve, throwing off more cash. We'll do a full sort of reforecast on the next few years as part of our annual report on where we see ourselves going. But as a company, as a group, I think it's fair to say everyone on site is really happy about where the operation is now versus where it was 3 months ago. 3 months ago, we were struggling. There was just fires everywhere. Whereas now we're getting down to a lot more consistent operation, seeing the gold coming out every week. We're seeing things really start to hum. So as a company, we're happy with where we are. And it's just, frustrating that the share price is probably going the other way from where our own internal...
Well, not everyone, I'm talking about investors, not everyone had a great year last year, right? So they have to realise some losses and, maybe recalibrate their own portfolios. And I say that's fine. They don't care what you think. They've got to sort themselves out, and that's fine. But I want to talk about the timing of this as well and get some sort of comfort from it, because would you possibly have, if there wasn't that stumble, the water, do you think you would have refinanced sooner, and therefore the knock-on effects that you've seen?
If we hadn't had the water and other issues, we wouldn't have needed to refinance.
It's like that.
Yeah.
It was that big a impact. Okay, well, it's a shame you've been marked down as much as you have, if that's the case. Because I think mining has these moments.
It does. We'd prefer that they didn't.
Sometimes not your choice, unfortunately, in this sector.
No. You think, we've a lot of our consultants and a lot of our team, there's been a lot of effort put into these things, and there was a couple of issues that weren't foreseen, and you never know until you're actually up and running. In a perfect world, they wouldn't have happened, and we're disappointed they have happened, and we've learnt a lot. So for our next expansions, we will be focused a lot more in a couple of areas that have let us down this time, and make sure it doesn't happen again.
Right. So we're coming from a low base, and I mean this with respect to your shareholders as well. Obviously, it's an opportunity for non-shareholders, but it's also good news for shareholders, and so it should attract a lot of new money coming into the company. I would have said, for a producer, there aren't too many companies that kind of got into production and didn't know as explosion on their balance sheet because of inflationary pressures and costs and so forth. So congrats. I'm going to say congrats on the announcement today, but you got a bit to deliver, and come back and tell us all about it, okay?
Fantastic.
Okay.
Cheers.